You think I should get rid of it or hold on to it?
Well, one blog that everyone tends to follow, or that is quite popular amongst a lot of Wall Street, is ZeroHedge. It's a financial blog that, as I mentioned, a lot of people follow. And yesterday afternoon, they posted this piece, which is gaining a lot of attention. The author of the blog is someone supposedly by the name of Tyler Durden. And I should highlight, we don't know who he is or she or who they are. But again, this is what's been circulating. Something tells us that Canadian sovereign CDS, not to mention Canadian bank CDS, are both about to go quite a bit wider, based on the fact is the next domino to fall, Canada. Now, the reason that he talked about this, he looked at global banks with tangible common equity of under 4%. And according to the calculations they posted, 30% of those were Canadian banks. So here to give us his take on this, also banking expert Campbell Harvey, professor of international business at Duke University. Thanks so much for joining us.
Good to be on the show again, Kim.
Campbell, so the reason we want to talk to you today is, and I should mention, I talked to a lot of analysts today and a lot of different people, and everyone had some pretty pointed opinions on what this meant. But there was a blog that came out today that implied that perhaps Canadian banks just aren't as stable as we think they are, based on this 4% tangible common equity number that was out there. What do you think of that thesis?
Well, I think the person, whoever it is that wrote this blog entry, is amazingly uninformed, doesn't know the basics of banking or of risk management. Indeed, it's like gutter journalism. You can't just look at the tangible equity ratio. You have to look at the quality of the assets. So if some of the assets, let's say a Canadian bank holds, are, let's say, Canadian government bonds or bonds of government of Norway, that's a lot different than a bank holding assets that are the government of Greece. So it's very important to look at the differences in the risks of your assets. And when you do that, the Canadian banks are amongst the most conservative in the world. So this domino notion doesn't make any sense.
Let me ask you, though, just so that our viewers understand just where this person was, or people were coming from. They looked at basically the tangible common equity, and of course it's divided by the assets on the books. But what you're saying is that people should look at risk-weighted assets, essentially, and those are adjusted for the quality of assets on there. When the banks do this calculation, and this is the difference, they say they have a tangible common equity ratio closer to 10% versus this 4%. Do you think that 10% number is the more accurate of the two?
It is definitely more accurate. It is the right comparison. If you're doing risk management as a regulator or even within a bank, that's what you have to do. You cannot compare assets that are of vastly different risks the way that this summary number actually does. You have to look at the quality.
Let me ask you, though, and so each bank provides this number, this tangible common equity number, to let people know how much, the quality of assets and the reserves they have on the books. But every bank, do they not do this all a little bit differently? Like, this is not an apples to apples to apples comparison. We don't actually have any transparency in that number, do we?
Well, this is actually, it's a very important question. And Basel III, one of the good things that it's doing is trying to make all of these numbers comparable. So it'd be one way to calculate Tier 1 capital or tangible common equity, Tier 2, so that you can actually compare these ratios across firms. You're right that right now it's quite difficult to do, but those that study this carefully know that the Canadian ratios are in a fairly safe zone.
I know that one of the criticisms as well was the fact that a lot of the Canadian banks, perhaps a lot of the assets they're holding are Canadian mortgages, and if there was a Canadian housing crisis, that could, cause a haircut to those assets. Again, you don't think that's an issue?
Well, let's put it this way. In the United States, over half of the mortgages that are outstanding, the value of the house is worth less than the mortgage. The comparable number in Canada is about 7%. So it's vastly different risk situation. In addition, In the U.S., there's no recourse. So somebody can just walk away from their house if they owe more in the mortgage than the house is worth. In Canada, that's not the case, that the bank can actually go after your other assets. So again, you need to make the adjustment for risk. The mortgages that the Canadian banks hold are vastly less risky than a U.S. bank or a European bank especially.
Okay, let's change gears a little bit, because the reason this all came up, because it was a comparison of Canadian banks to European banks, and clearly you don't think that's an adequate comparison, but this is all being brought about because of European banking risk. And tell me, do you think that the markets have a really good sense of the domino effect or the counterparty risk right now that banks, not in Canada, but all around the world, have with the European banks?
Okay, this is a really good point. 2 days ago, some of the largest banks were called to the Federal Reserve Bank of New York, and basically the Fed was asking, do you understand your exposure to European banks? What if, let's say, 10 of the 91 systemically important banks in Europe fails? What's going to happen? And there's all sorts of counterparty linkages, and I'm not even convinced that the U.S. banks understand what their exposure is, and it's probably the case that the Canadian banks need to do some work to figure out what that exposure is. Indeed, I would hope that they are unwinding or buying insurance for some of the exposure to the most banks that are at extreme risk in Europe.
Can you give me a sense of what you think might happen if, one or two or a few banks do have some sort of credit crisis, liquidity crisis, how that might unfold over here in North America?
Well, I think the first thing that would happen in Europe, that the ECB would probably come in, bite the bullet, and basically monetize some of those banks. But if it goes beyond 2 or 3, then we're in serious trouble, because the ECB and the European Stability Fund just does not have the capital to deal with potentially a $1 or even $2 trillion situation. Then everybody's in trouble. We get kind of another global financial crisis. And let me say one thing. We talk about tangible common equity. Mm-hmm. Maybe it's not 3%, it's 10% with quality. But even 10%, that is a leverage ratio of 10 to 1. In my opinion, you can actually greatly reduce or even eliminate global financial crises by jacking up the required ratios to make these banks play on the same playing field that other corporations do. There's no other corporation that would think of a 10 to 1 leverage ratio. You just could not do that. So why do we let our banks have leverage like this, even though the Canadian ones are more conservative? It doesn't make sense. We're just inviting another crisis. How many times does, Citibank go zombie and get bailed out?
And then what should that number be, in your opinion?
It should be more than 10%. So even though I'm saying Canadian banks are in relatively good shape, I'm much more comfortable with ratios more near 25%. And then you reduce all of these costs. It is a horrible cost when people are laid off, dislocated for potentially years. The economy suffers. Everybody suffers. We can solve that situation with a more conservative global banking system. And it's got to be coordinated. It can't just be one country operating at a time. It's got to be coordinated, and it's got to be much more aggressive than the Basel III proposals.
So how, and just, while we're throwing the scenario out there, how do you think that could come about? I mean, we can't even seem to get the European countries to cooperate with each other, let alone a global movement to try and get, banks to be more conservative. So how might that happen?
Well, unfortunately, probably the way it's going to happen is with this European crisis. Indeed, even the Swiss are exposed because their two large banks are so large compared to the Swiss economy that the Swiss regulators say, well, forget the Basel III, we're going to be much more aggressive. And I think that given the trouble that Europe is in right now, the sort of resolution in the future will be much stricter regulations and mandating that banks cannot have the leverage that they have right now or what is even planned under Basel III. That is a way to solve the problem.
Campbell, great insights. We might be a ways off for that, but we'll certainly be talking to you between now and that time that these things actually come through. Thanks so much for joining us.
Okay, thank you, Kim.
Campbell Harvey, J. Paul Stick Professor of International Business at Duke University.